Hi, I'm Pattu from freefincal. Yesterday we talked about the Sensex having hit the third longest losing streaks, that is 12 negative days out of a 15-day rolling window. And today let's talk about how the Sensex has grown, how the Sensex and S&P 500 have grown between leap year to leap year. So today is 29th of February. As you all know, 2020 is a leap year, and let's find out how these two indices have grown and if there are some lessons from it. So there are only 11 data points from April 1979 for leap years, and you can see them. The blue is the growth of the Sensex shown in log scale, and the red is the annualized return or the CAGR for every 4-year period, that is from leap year to leap year. And if you actually look at the data, you can see that on 29th February 1980, the Sensex closed at 128.21. On 28th February 2020, the Sensex has closed at 38,297. That's a big jump. That is almost exactly 15% without counting for dividends. Dividends you can take about 1.5 to 2%, so that's almost 17% annualized growth in the Sensex without taking into account the ups and downs, just the point-to-point growth. And if you actually look at the returns, you can see here in the first leap year period, that is between 80 and 84, it is 18% growth, 84 to 88, 13%, 88 to 92, that's when the Harshad Mehta manipulation was at its peak, 65% annualized return. And then it fell, 92 to 96, it is only 3%. And then from 2000 to 2004, it was just 1%. And 2008 to 2012, after the crash and the recovery and the recession and so on, it is just about nothing, 0%. It didn't fall much. So, and then between 2012 to 2016, it is 17%. Of course, 2012 to 2016 is 7% excluding dividends. And for the other ones that I mentioned, the 0%, 1%, 3%, even if you include dividends, it would have still not bet fixed deposit options that were available at that time. It would have still not bet the inflation that was available at that time. So even with 11 data points, you're able to understand the way the Sensex operates. You can see here it zooms up and then it slows down. There's a long slowdown period. Then it zooms up. Then there's a slowdown. That's why I had made a video on the Sensex staircase, and you can see how the staircase operates. There will be a period of nothingness. Nothing will happen. This is the time to invest. A period in terms of downturns like this, the time that we are going to have, we may be having a sideways market, if not a crash for an extended period of time for months and months. If this happens, this is the perfect time to invest as long as your goals are very long term. There's no doubt about that. But this is when people make, shall I buy, wait for a big dip? Just put that damn money. You don't know how the market's going to work. You just recognize that it's going to be a little volatile for some time. That's the time you invest. Now going over to the S&P 500, you can get the data from Professor Schiller's website. I have taken that he has maintained monthly data from 1872. There are 37 leap years in that period, and you can see the S&P 500 from leap year to leap year, and you can see it's not much of volatility there. It almost looks like it's going up, but that's of course shown in log scale. And incidentally, most US elections happen on a leap year. So that might be I mean that they talk about the 4-year period as a market cycle in the US. That could be one of the reasons why it's nice and smooth. Of course, it's not nice and smooth in terms of actual returns. I have shown both the annualized return and the annualized real return, taking into account inflation. And there are periods during the Great Depression in the late 1920s, in the early 1920s, late 1920s, when even though equity has given positive returns, including dividends, because of the inflation, the real return was significantly negative. Then they had an oil crisis in the late 80s. The inflation became high again. There was another recession then. Again, during periods of recession, you can see that equity does not help you beat inflation. Of course, you can say it's 4-year returns and so on, but still, this does translate into longer period returns. I have shown that for SIPs, rolling return SIPs for Sensex and S&P 500. So that's what I want to say in this video. You can see that it's a lot of you can see the market risk in that leap year to leap year window. Please share how were your personal finances in 2016 February, the last leap year. How have you changed? How has your money management style evolved over these 4 years? Sorry, how are you positioned in 2020? What do you think will your money management life be in the next leap year, which is going to be 2024? So that's what I want to say. Please share these in the comments. Bye bye.